If you're a freelancer or self-employed, there's a tax you probably didn't know about until you filed your first return. Self-employment tax. It's 15.3% of your net income, and it's on top of your regular income tax. For most freelancers, this is one of the biggest tax bills they pay, and it catches people off guard because it's separate from federal and state income taxes. I'm going to explain exactly what self-employment tax is, how it's calculated, why the rate is 15.3%, and most importantly, how to reduce it legally. Let's dive in. First, let's talk about what self-employment tax actually is. When you work a W-2 job, you pay Social Security and Medicare taxes through payroll withholding. You pay 7.65% and your employer pays 7.65% for a total of 15.3%. When you're self-employed, you don't have an employer. You're both the employee and the employer. So you pay both halves, the full 15.3%. That's self-employment tax. It's how the IRS collects Social Security and Medicare from freelancers, gig workers, and small business owners. The 15.3% breaks down like this. 12.4% goes to Social Security. 2.9% goes to Medicare. That adds up to 15.3% total. But here's the twist. Social Security tax only applies to the first $184,500 of your net self-employment income in 2026. That's called the Social Security wage base. If you make more than $184,500, you stop paying the 12.4% Social Security portion on the excess. You still pay the 2.9% Medicare tax on all your income, no matter how much you make. There's one more layer. If you make over $200,000 as a single filer, or over $250,000 if you're married filing jointly, you pay an additional 0.9% Medicare tax on the excess. So high earners are paying 2.9% plus 0.9% for a total of 3.8% Medicare tax on income above those thresholds. Let me give you some examples so you can see how this works in real life. Example 1. You're a freelance designer and your net profit for 2026 is $60,000. You're under the Social Security wage base of $184,500, so you pay 15.3% on all of it. But there's a calculation quirk. You don't pay 15.3% on the full $60,000. You pay it on 92.35% of your net profit. Why 92.35%? Because if you were a W-2 employee, your employer's share of Social Security and Medicare wouldn't be part of your taxable wages. The IRS adjusts for that by multiplying your net profit by 92.35%. It's weird, but it's the rule. So $60,000 times 92.35% equals $55,410. Now multiply that by 15.3%. Your self-employment tax is $8,470. That's on top of your income tax. If you're in the 22% federal tax bracket, you're also paying around $13,200 in income tax on that $60,000. Combined, that's over $21,000 in taxes. That's why freelancers get sticker shock when they file. Example 2. You're a consultant, and your net profit for 2026 is $200,000. You're above the Social Security wage base of $184,500, so Social Security tax caps out. Here's the breakdown. First, $184,500 in net income. You pay 12.4% Social Security plus 2.9% Medicare, which is 15.3% total. But again, on 92.35% of that income. So 184,000 times 92.35% equals $173,86. Times 15.3% equals $26,089 in self-employment tax on the first $184,500. The remaining $15,500 of income. You only pay Medicare tax, which is 2.9%. But because you're over $200,000 total income, you also pay the additional Medicare tax of 0.9% for a total of 3.8%. On 92.35% of $15,500, that's about $543. Total self-employment tax, around $26,632. That's a big number. And again, That's separate from income tax. Let's talk about the threshold. The IRS says you owe self-employment tax if you have net self-employment income of $400 or more. That's a very low bar. If you made $500 on a side gig, you technically owe self-employment tax, even if it's just a few dollars. Net income means revenue minus business expenses. If you made $10,000 in freelance income, but you had $6,000 in legitimate business expenses, your net income is $4,000. You pay self-employment tax on the $4,000, not the $10,000. This is why deductions matter so much for freelancers. Every dollar you deduct reduces not just your income tax, but also your self-employment tax. If you're in the 22% income tax bracket, a $1,000 deduction saves you $220 in income tax plus about $153 in self-employment tax for a total of $373. That's real money. Now let's talk about how to reduce self-employment tax legally. There are a few strategies that actually work. Strategy 1 is to maximize your business deductions. Home office, mileage, equipment, software, professional development, all of it reduces your net profit, which reduces your self-employment tax. I cover the top deductions in other videos, but the key is to track everything and claim every legitimate expense. Strategy 2 is to contribute to a retirement account. Solo 401k contributions and SEP IRA contributions reduce your net self-employment income before you calculate self-employment tax. If you contribute $20,000 to a solo 401k, your net income drops by $20,000, which saves you about $3,060 in self-employment tax. Plus, you're building wealth for retirement. It's a double win. Strategy 3 is to structure as an S-Corp if you're making enough money. This is the big one. When you're an S-Corp, you pay yourself a reasonable salary and the rest of your profit is taken as a distribution. You pay payroll taxes on the salary, but not on the distribution. Let's say you make $150,000 in net profit. If you're a sole proprietor, you're paying about $22,950 in self-employment tax on all of it. If you're an S-Corp and you pay yourself a $60,000 salary and take $90,000 as a distribution, you only pay payroll taxes on the $60,000. That saves you about $13,770 in taxes. The catch is that your salary has to be reasonable. The IRS will challenge you if you pay yourself $30,000 and take $120,000 as a distribution. A safe rule of thumb is to pay yourself at least 40% to 50% of your total profit as salary. And S-Corp have extra admin costs, payroll processing, tax filings, accounting fees. So this strategy usually makes sense once you're making at least $80,000 to $100,000 in net profit. Here's the piece most people miss. You can deduct half of your self-employment tax on your income tax return. It's not a deduction for calculating self-employment tax itself, but it is a deduction for calculating your adjusted gross income. So if you paid $8,100 in self-employment tax, you can deduct $4,039 on Form 1040 Schedule 1. This lowers your income tax. It doesn't eliminate the self-employment tax, but it softens the blow. This deduction happens automatically when you use tax software. It shows up on Schedule 1, line 15. If you're doing your taxes by hand, don't forget it. Let's talk about Schedule SE. This is the form you use to calculate your self-employment tax. It's a one-page form that takes your net profit from Schedule C, multiplies by 92.35%, then applies the 15.3% rate with adjustments for the Social Security wage base. You file Schedule SE with your Form 1040 every year. If you have multiple businesses, you combine all the net income and calculate one total self-employment tax. You don't calculate it separately for each business. Here's a question I get all the time. If I have a W-2 job and a side hustle, do I still pay self-employment tax on the side income? Yes. The self-employment tax applies to your freelance income regardless of whether you also have a W-2 job. But here's the nuance. Your W-2 wages count toward the $184,500 Social Security wage base. So if you made $100,000 in W-2 wages and $60,000 in freelance income, your total income is $160,000. You're still under the $184,500 cap, so you pay full Social Security tax on all the freelance income. But if you made $150,000 in W-2 wages and $60,000 in freelance income, your W-2 wages already ate up most of the cap. You'd only pay Social Security tax on the first $4,500 of the freelance income. The rest would only be subject to the 2.9% Medicare tax. This is automatically calculated on Schedule SE. The form asks for your W-2 wages and adjusts accordingly. Here's what you need to do right now. First, understand that self-employment tax is separate from income tax. You're paying both. Budget for it. A good rule of thumb is to set aside 25% to 30% of your net income for all taxes combined: federal income, state income, and self-employment. Second, track all your business expenses throughout the year. Every deduction reduces your self-employment tax and your income tax. Use accounting software like QuickBooks, FreshBooks, or even a spreadsheet. Don't wait until tax season to figure out what you spent. Third, make quarterly estimated tax payments. Self-employment tax is included in your estimated payments. If you're making $60,000 a year, you're looking at around $8,500 in self-employment tax plus your income tax. Divide that by 4 and pay it quarterly to avoid penalties. Fourth, consider contributing to a solo 401k or SEP IRA. The contribution reduces your self-employment tax and saves for retirement at the same time. If you're making $80,000 or more, talk to a CPA about whether an S-Corp makes sense for you. Self-employment tax is one of the biggest expenses for freelancers, but it's also predictable. If you know the rate is 15.3%, you can plan for it. Maximize your deductions, contribute to retirement, and if you're making enough, look into S-Corp status. The tax system penalizes freelancers with self-employment tax, but it also gives you way more deduction opportunities than W-2 employees ever get. Use them. If this was helpful, hit subscribe for more freelancer tax strategies every week. Drop a comment with your net income, and I'll estimate your self-employment tax. See you in the next one.